Is the U.S. stock market in a bubble? Insights from billionaire investor Jeremy Grantham. Billionaire investor Jeremy Grantham has gained a reputation as a doomsday oracle for his accurate predictions of major stock market crashes throughout his career. In this video, we will explore Grantham's views on the current state of the U.S. stock market and whether it is in a bubble. We will also discuss the impact of low interest rates on stock prices and the psychology behind market bubbles. Grantham's perspective. Grantham believes that the U.S. stock market is dangerously overvalued and that it is descending from the 2021 bubble, which he considers one of the great bubbles. He suggests that the market is entering a deflationary period, characterized by declining earnings, profit margins, and a potential recession. Grantham predicts that the recession may start in 2023, despite the Federal Reserve's projection that a recession is unlikely. The role of the Federal Reserve. Grantham criticizes the Federal Reserve's track record in predicting and handling recessions. He believes that the Fed's focus on stimulating asset bubbles has led to their failure in recognizing and addressing the deflationary effects of asset price declines. Grantham also expresses skepticism about the Fed's ability to control inflation, stating that inflation will likely be higher than the average of the past 10 years. The impact of low interest rates. One of the key factors driving the U.S. stock market's performance over the past 15 years has been historically low interest rates. Grantham explains how interest rates affect the value of assets such as stocks, bonds, and real estate. Lower interest rates lead to higher asset prices, as investors discount future cash flows at a lower rate. This phenomenon has fueled the stock market's growth, but Grantham warns that the era of low rates may be coming to an end, leading to a potential decline in stock prices. The psychology of market bubbles. Grantham delves into the psychology behind market bubbles, highlighting the fear of missing out, FOMO, as a driving force. He explains that when people see others making significant profits in the stock market, they feel compelled to participate, even if it means disregarding fundamental analysis. Grantham references the famous example of Sir Isaac Newton, a brilliant scientist who lost money during a financial bubble in the early 18th century. This demonstrates that even highly intelligent individuals can succumb to the allure of easy money. Grantham's advice. Given his concerns about the U.S. stock market, Grantham recommends investing in a global index fund with a focus on markets outside the U.S. He believes that the overpricing in the U.S. market is primarily a domestic issue, while markets outside the U.S. are not as overpriced. Assessing the U.S. stock market. To determine whether the U.S. stock market is overvalued, Grantham suggests looking at the price-to-earnings (PE) ratio. Comparing the U.S. PE ratio to other countries, he argues that U.S. stocks are expensive. However, it is important to consider the U.S. market's unique characteristics, such as the presence of large and profitable companies that attract global investors. Conclusion. Jeremy Grantham's insights provide valuable perspectives on the current state of the U.S. stock market. While he warns of a potential bubble and a forthcoming recession, it is essential to consider various factors, including interest rates, market psychology, and global market comparisons. Investors should carefully evaluate these factors and seek professional advice to make informed investment decisions.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.